All right, everyone, get ready for a deep dive. We're tackling passive real estate investing today, building wealth through property, but without being a landlord.
Yeah, no more late night calls about a leaky faucet.
Exactly. No chasing down rent checks.
It's amazing all the different ways you can invest in real estate passively these days.
Our sources cover a ton of options, right?
Oh, yeah, from REITs to crowdfunding platforms.
And even teaming up with other investors.
You don't have to be a millionaire to get started.
Some of these sources actually say you can get started with a surprisingly small amount of cash.
That's right. And that's the beauty of passive real estate. You can start small, let it grow over time.
Like compound interest, but for real estate.
Exactly.
Okay, let's break down some of these options. We've got REITs, which I always thought of as like, well, they're kind of like the stock market's version of real estate.
Yeah, that's a good way to think about it.
You're not buying a property directly.
Right.
Instead, you're buying shares in a company that owns and manages properties.
And those shares represent a piece of their real estate portfolio.
So it's not just one property. It could be a slice of like
Mm.
residential, commercial, even things like data centers.
Exactly. Diversification is a huge advantage. Plus, REITs usually pay dividends.
So you get a stream of passive income.
Yep.
That's pretty appealing, especially for someone who wants exposure to real estate, but likes the liquidity of the stock market.
For sure. Now, on the other side, we have direct ownership with a property manager. You buy a rental property.
But you're not dealing with the tenants or repairs yourself.
Nope. You hire a professional to handle everything.
So it's still passive, right? Because you're not actively managing it.
Exactly.
And this can be a good option for people who really like the idea of owning tangible assets and building equity in a specific property.
Yeah, fairly.
Now, we also have crowdfunding. That seems to have really taken off.
It has. Crowdfunding platforms let you pool money with other investors.
So you get into bigger projects, right?
Exactly. And sometimes you can start with just a few $100s.
Wow, that's amazing. So you could own a tiny piece of a skyscraper.
It's pretty incredible, huh? And we also have syndications.
Which are basically partnerships, right?
Right, partnerships formed to buy and manage real estate.
So it's like joining forces with other investors
Yeah,
to get into bigger deals.
exactly.
It sounds like another good option for someone who's not quite ready to go it alone, but wants to be a little more hands-on than with REITs.
Yeah, that's a good way to put it. And the best part is you can really tailor these options to your goals and risk tolerance.
All right, let's talk benefits. What makes passive real estate investing so attractive?
Well, first of all, it's the potential to build wealth without having to actively manage properties.
It's that dream of making money while you sleep.
Uh-huh.
But what else makes it stand out?
Well, one big advantage is portfolio diversification. Don't put all your eggs in one basket.
Right.
Real estate often acts differently than stocks and bonds.
So that can add some stability to your portfolio.
Exactly.
And real estate is supposed to be a good hedge against inflation, right?
It is. When inflation rises, so do property values and rents.
Which helps protect your purchasing power,
Exactly. Plus, the rental income you get can increase over time.
which can help offset rising costs.
Yeah, that's right.
Now, our sources also talked about tax advantages. Can you give us some more information on those?
Sure, real estate has some unique tax benefits, like depreciation deductions, which can really lower your tax burden.
And there's also the 1031 exchange.
Right, that lets you defer capital gains taxes when you sell an investment property.
Those tax breaks can really make a difference. So it sounds like passive real estate has a lot going for it. Potential for steady income, diversification, tax advantages, inflation protection. But we all know there's no such thing as a risk-free investment.
Of course not.
So let's talk about those downsides. What are some things investors should watch out for?
Well, for one thing, market fluctuations can always impact property values and rental income.
So even though it's passive, we still need to stay informed about what's happening in the market.
Absolutely. It's important to do your research, understand the local market, and be prepared for ups and downs.
Don't panic and sell at the first sign of a dip. Right.
Right, exactly.
Patience is key. Now, another risk I've heard about is liquidity.
Uh-huh.
Real estate isn't exactly known for being easy to sell quickly.
That's true. It can take time to sell a property, and you have to factor in transaction costs.
So you need to have a plan for unexpected expenses and keep a healthy emergency fund.
Definitely.
If you're relying on your passive real estate for immediate income, you might need to rethink your strategy.
Yeah, definitely. You have to match your investments with your financial goals and timeline.
Our sources also mention property management issues, even with a passive approach.
Oh, yeah. Even with a good property manager, things can go wrong. Tenant problems, unexpected repairs, vacancies.
All of that can eat into your profits.
It definitely can. And create headaches you weren't expecting.
Sounds like finding a good property manager is absolutely essential.
You got it. Vetting them thoroughly is so important. Don't just go with the cheapest option.
Right. Look for someone with a proven track record and strong references.
Exactly. And good communication skills, too.
Yeah, that's important. You want to be able to stay informed about what's going on with your property.
And don't forget about interest rates. They can have a big impact on real estate, both in terms of financing costs and how the whole market behaves.
Oh, yeah. Rising interest rates make it more expensive to finance a property, which can really affect your cash flow. And they can also influence what investors do, right? Like maybe change demand or property values.
Exactly. It's a whole web of factors. And you need to know how interest rate changes could affect your investments.
So you might need to switch up your strategy or think about different financing options.
Right. You might even want to wait on certain investments until the market looks better.
It's a lot to consider, but that's what these deep dives are for. So let's say someone's listening to this and they're thinking, okay, this sounds great, but where do I even start?
That's a great question.
What are the first steps?
Well, before you jump into any investment, you need to be clear about your financial goals.
What are you hoping to get out of passive real estate?
Right. Are you looking for short-term cash flow, long-term growth, maybe a bit of both?
So it's not just about chasing the highest returns.
No, not at all. You need a strategy, one that fits your own situation and goals.
It's like having a roadmap to guide your decisions.
Exactly.
And once you have that roadmap, you can figure out what's realistic for you financially.
Right, exactly.
How much can you actually invest?
Without putting yourself in a tough spot.
I remember when I started out, I made this detailed budget to track my income and expenses
That's smart.
and how much I could actually put toward investing.
Having a clear budget is so helpful. It helps you figure out how much you can realistically invest and make sure you're not overdoing it.
Yeah, for sure. And then, of course, there's education. You can't just jump into any investment without doing your homework.
Absolutely not. You have to research and understand your options.
The pros and cons of each approach.
Right. Think about which ones match your goals and budget, and look into different ways to manage risk.
Like any big decision, right? The more you know, the better choices you'll make.
Exactly.
So, okay, you've done your research, you're ready to get started. How do you actually choose the right investment? REITs, crowdfunding, syndications, direct ownership. It's a lot.
It can be, but that's where your investment strategy comes in, and that financial assessment we talked about.
So you choose an investment that fits your risk tolerance, your timeline,
Yeah.
and how much you can actually afford to invest.
Exactly. If you want liquidity and diversification,
Mm-hmm.
maybe REITs or real estate ETFs are a good fit.
And if you're more into direct ownership,
Yeah.
but you don't want the hassle of managing it, then turnkey real estate or crowdfunding platforms could be good options.
Exactly. It's all about balance, finding that sweet spot between your goals and your comfort level.
And remember, you don't have to go alone.
That's right.
Getting advice from professionals can be really helpful, like financial advisors, real estate experts, tax professionals.
They can be so valuable. They can help you navigate all the complexities, make sure you're making smart decisions.
It can make the whole process less scary. So even with expert advice, it's probably best to start small, right? Gradually build your portfolio.
Absolutely. Starting small lets you learn the ropes, test out different strategies,
Mm-hmm.
and minimize your risk.
Right, and as you gain experience and see things going well, then you can start investing more.
Exactly. It's a marathon, not a sprint, remember?
That's such a good point. It reminds me of the power of compound growth. Those small, consistent investments over time.
They can really add up.
It's like planting a seed and watching it grow into a tree.
Exactly. That's compound interest at work. It applies to real estate just like any other investment.
The key is to start early, stay disciplined, and be patient.
You got it.
And as we talked about before, diversification is super important.
For sure.
Spreading your investments across different property types and locations, it can help you manage risk.
It's like a safety net for your investments.
Exactly.
Okay.
But even with a diversified portfolio and understanding the risks, it's easy to get tempted by those big returns or get caught up in the hype.
Oh, yeah.
So how do we avoid falling for marketing gimmicks? How do we make sure we're making smart decisions?
It all comes down to due diligence. Don't just rely on what the marketing materials say.
Right. Dig deeper.
Analyze the total returns over time. Look at the income, appreciation, and costs.
So don't just focus on the potential upside. You need to consider the expenses and the risks too.
Exactly. Look at the whole picture. Examine things like occupancy rates, rent growth, and capitalization rates.
Those are all important indicators of how well a property is doing, right?
They are.
But they can be a little confusing at first.
They can be.
Where can we go to learn more about them?
There are tons of resources online and in financial publications. And, of course, don't hesitate to talk to financial advisors or real estate experts.
They can help you make sense of all the numbers.
Exactly.
Having a trusted expert in your corner can make things so much easier.
For sure.
Now, you mentioned REITs earlier. Are there specific things we should look at when we're evaluating those?
Yes. For REITs, funds from operations, or FFO, is a key metric. It's kind of like earnings for a regular company.
It shows how much cash flow the REIT's getting from its properties.
Exactly.
So if the FFO is steady and growing, that's a good sign.
It is. It means the REIT is in good financial shape and can keep paying dividends and growing its portfolio.
Got it. Now, you also mentioned risk-adjusted returns. Why are those so important?
It's not just about getting the highest returns. It's about finding the right balance between risk and reward.
Right, because a high return might sound great, but if it comes with a lot of risk, it might not be the best choice.
Exactly. Especially for someone who doesn't like taking big risks.
So a lower return with less risk could actually be a better investment, especially if it helps you sleep at night.
Exactly. Risk-adjusted returns consider the level of risk involved, so you get a more complete picture of how the investment might perform.
Makes sense. And don't forget about fees,
Oh yeah, those can really eat into your profits.
if you're not careful. It's important to compare fees across different investments.
Absolutely. Every little bit counts, especially when you're investing for the long term.
Right, over time, those small differences can make a big impact.
Exactly.
And if you're looking at syndications or crowdfunding deals, you really need to check out the business plan and prospectus.
Yes. Look for realistic projections, a solid track record, and experienced management teams.
Even with passive real estate, due diligence is still essential.
Absolutely. You want to be sure your money is being invested well and that the people managing it are trustworthy.
Knowledge is power.
You got it. Don't be afraid to ask tough questions. And if something doesn't feel right, walk away.
It's pretty amazing, when you think about how a little bit of money invested the right way, consistently, over time, can turn into something big. That's compound growth at work. And it's not just for real estate.
Right. It applies to all kinds of investing.
It's like that saying, the best time to plant a tree was 20 years ago. The second best time is now.
Exactly. It's never too late to start.
And there's so much happening in real estate these days, so many new ways to invest.
The future of passive investing is looking pretty exciting.
What are some of the trends that you're most excited about?
Well, one thing that I find really interesting is the rise of these fractional ownership platforms.
Oh yeah, I've heard about those.
They make it so much easier for people to invest in high-value properties without needing a ton of money.
So instead of buying a whole apartment building, you can own a little piece of it.
Exactly.
And these platforms usually handle all the management stuff, right?
Right. It's truly passive for the investor.
Like they're democratizing real estate investing.
Yeah, I think so.
It's amazing what technology can do.
It really is.
What other innovations are you keeping an eye on?
I'm also really intrigued by blockchain technology.
Oh, interesting.
It has the potential to really change how real estate transactions work, make everything more transparent.
I can see that.
Imagine if all property records were on a blockchain. It would be so much easier to verify ownership and transfer titles.
That would be huge. It would cut down on fraud, reduce paperwork, make the whole process more efficient.
Exactly.
It's exciting to think about the possibilities.
It really is. And as technology keeps developing, we're going to see even more creative ways to invest in real estate passively.
So for our listeners who are ready to jump in, what are your final words of wisdom?
I would say, first and foremost, do your research. Really understand the different options, the risks, and how to manage those risks.
Don't be afraid to ask questions, right?
Right. Find some experienced professionals and get their advice.
Like we've been saying, knowledge is power.
It really is.
And once you've got that knowledge,
Yeah.
don't be afraid to start small.
Exactly. Start with an amount that you're comfortable with. Learn as you go, and gradually build up your portfolio.
Remember, it's a marathon, not a sprint.
That's right.
And most importantly, be patient.
Yes.
Compounding takes time.
But the payoff can be amazing.
It's all about setting realistic expectations, staying disciplined.
And enjoying the journey.
Well said. Well, that brings us to the end of our deep dive into passive real estate investing. We hope you've enjoyed it and learned some valuable things along the way. Remember, building wealth through real estate is possible, no matter where you're starting from. Embrace passive investing. Let your money work for you so you can focus on living your best life.
Happy investing, everyone!